All right. Good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner, and we're here live with you again to answer questions for you, specifically today about life insurance and how to use that for estate planning purposes. Now, we've talked around this idea several times on the podcast before, but we haven't directly done an episode to specifically target this question and answer your thoughts and concerns and considerations around the idea of estate planning, and specifically the idea of paying estate taxes utilizing life insurance. So, if you're in a position where you are concerned about estate taxes for various reasons, and we're going to unpack kind of what that means and why you may or may not be thinking towards estate taxes on the basis of your estate size, and you want to limit the amount of estate tax, you are in a position potentially of looking to have life insurance be a tool that you could utilize to pay for those taxes. And then the question arises, what type of policy should I use? And should I lean on a whole life insurance policy? Should I lean towards a universal life policy or some other variation of a universal life policy? And or should I look at meching a policy? Now, some of these words may or may not be familiar or unfamiliar to you, but there's of course reasons why different professionals may recommend different strategies. And really what we want to do today is help you understand the context and really look at the pros and cons of being able to utilize a tool for paying estate taxes in the most efficient and effective way possible. So I'm really pleased to be able to have this conversation with you today. And Bruce, thank you for joining me.
Yeah, the only thing I'd like to start out with a clarification is, we do a lot of podcasts on special design whole life insurance contracts to utilize the infinite banking concept. We are not talking about that today. We don't want anybody to get confused about using universal life products for the infinite banking concept. That's not anywhere near our radar. We are specifically talking about using life insurance products for estate planning purposes. And there's pros and cons of which type of product you use. And there are people that are still going to say, well, you should never use universal life products. And I wouldn't say I'm in that ballpark, but I'm certainly leaning to that situation that people need to understand the risk involved with universal life products to use them even for estate planning purposes. But it just so happens that high net worth people that are using a need and are looking at estate planning, they are dealing with risk on a daily basis with all of their investments and their businesses and so on and so forth. So they understand how to use risk to benefit them and are comfortable with it. If you're not comfortable with risk, even in estate planning, then you certainly we'll dive into this deeper, but certainly you would use a whole life product. And we'll talk about the pros and cons as we go along for the estate planning purposes.
So, Bruce, let's go ahead and first talk about the difference between various types of products just in general, especially for somebody who might be coming to this conversation. Well, actually, maybe we should start first by talking about why you would use life insurance to handle estate taxes.
Well, that's another thing I was thinking about, Rachel, as I was thinking about this podcast is we're specifically talking about it for estate planning to pay for estate taxes. However, estate planning could also be that you want to leave the greatest amount of money to the next generation in the most uh, efficient way, and that would be what I would call a leveraged up death benefit. In other words, a smaller amount of premium will produce a greater amount of death benefit. So even if you're just even if you're below the exemption, which is north of $26.5 million right now, even if you're north of that, in other words, you don't have to pay estate taxes until you get above that number. So a lot of people were like, well, I'm never going to fall into that. You may want to listen to the podcast because President George Bush, when he was in office, the exemption was only $1 million per person. And with our current debt here in April of 2025, rapidly approaching after this year's budget, rapidly approaching $40 trillion, you would think that the United States government would need to build up more revenue into the future. So one of the ways to do that would be to actually lower the estate tax exemption and get taxes after you die, not while you're living. So that's a reason why you might do it. And then the other reason is, hey, I'd like to leave as much money as possible in the most tax efficient manner to the next generation. So I'm considering life insurance. So let's talk about the three types you could use.
Actually, Bruce, I just want to clarify the whole leaving as much money as possible in a tax efficient manner to the next generation. So let's just talk about really briefly what is that tax efficient manner? Why is life insurance a tax efficient manner? And I'm just going to put the simple, and you can add the more expanded understanding on that. So we talk about life insurance as having a triple tax advantage. You have, when you're building up cash value, you have deferred growth or deferred taxation on the growth of your cash value, meaning you do not pay tax on the increase of your cash value year after year. Now, deferred sounds like you're going to pay that tax at the end, and certainly you could pay that tax on the growth of your cash value at the end if you access the policy through withdrawals over the cost basis or the amount that you've placed into the policy. However, if you use life insurance loans or loans against your cash value to access your cash value, you do not pay taxes on those policy loans. So you can have an experience of tax-free utilization of your cash value. I want to be clear that that's an experience of tax-free utilization. It's actually tax-deferred growth on your cash value that you can access in a tax-free way. So you have tax-deferred growth of your cash value. You have tax-free policy loans, and then your death benefit is income tax free to your heirs. And so when you recognize that the death benefit that is paid by your life insurance policy to that second generation is tax free, meaning it will not, Bruce, you can speak to exactly how that impacts your estate. I don't want to misspeak on that.
Yeah, so very, very good. So uh, people always talk about the income tax benefits of life insurance. And so to get this out of the way and just clarify this right away, no matter what the tax classification as you're when you're alive, and we'll talk about the different classifications when you're alive, when you pass, the death benefit is always tax free, always. Okay, so income tax free. So just remember that. Okay, no matter how they classify it while you're living. Now, if
Meaning
you want
your
to,
heirs don't pay income tax on the life insurance death benefit that they receive from your policy, correct?
correct, correct. Um, Now, as Rachel was saying, is if we kind of go through the ways you can get a death benefit, the different types of life insurance, there is term, and that term insurance is what most people are used to because of having group term at their place of work. It's simply a death benefit with a payment that does not build up any cash value. Thus, you don't have to worry about accessing the cash value, whether it's tax deferred or taxable upon getting it, because there is no cash value. And it's the smallest amount of premium you're going to pay per $1,000 of death benefit. So that one's really easy. You don't have to worry about the tax implications while you're living because it's not building up any cash value. And we've already said when you die, all tax benefits are given to death benefits. So you don't have to pay any income tax on the death benefit. Then you go to the next stage of life insurance, and that would be what they call permanent life insurance. Now, permanent kind of can get a little tricky because what they're saying for it, the death benefit is permanent as long as you can make the premium payment. But the premium payment on some of these vehicles are not guaranteed. So, universal life, variable universal life, and index universal life are examples of what they call permanent policies that will stay in force as long as you make the premium payment, but the premium payment is not guaranteed. So
which
keep that in
means,
mind.
which means not that you may not have a premium payment, but that if your illustration says, in order to keep this policy in force, you pay in $10,000 per year, the not guaranteed portion means that that could actually, the policy may require above the initial $10,000 per year in order to perform according to the specifications that you expected in the beginning. I don't know if there's a clearer way to say that.
Well, one of the ways maybe I'll attempt it is all of those policies have a premium that is dependent upon what you would like to pay. It's called a flexible premium. Part of the premium is your responsibility, but it within that premium payment, they're also presuming that you're going to make so much money on what are called side accounts. Universal life is actually an interest driven account. Variable universal life actually uses the stock market or mutual funds to actually pay, hopefully, some of the premium. And then finally, index universal life is hoping to use crediting that is targeted towards different actual indexes. And those indexes are very commonly, one of them is the S&P 500 index. So if that index performs well, you will get additional crediting, and part of that crediting then could use, or all the crediting if you choose, could be used to pay the premium. So that's where it's not guaranteed. They're projected to perform the way they perform, but they're not guaranteed the way they perform. So if you do, now make this very, I want to make this very clear. If you do not make the maximum premium that is in the contract, and many people take these out because they're like, I don't want to make the maximum premium. I want to use part of the premium that's going to get paid for by the crediting or the mutual funds or the interest. I want them to help me make the payments. Then I will not make the entire premium payment because I'd like to use that money other places. If you're comfortable with that, then that would be the one that you may consider. But know that if they do not perform, the interest, the stock market, or the index does not perform, down the road, they may come back to you and say, hey, we thought it was going to perform this way, but it didn't. In order to keep the same death benefit intact, we're going to need additional premium. And or you could lower the premium and still pay the same, uh, or have you can excuse me, you can lower the death benefit and still pay the same premium. So it's not totally guaranteed. Many people of high net worth are comfortable with that type of risk because they're saying to themselves, well, I understand it's pay me now or pay me later. I'd rather have that additional premium that I would have to put into a whole life insurance contract because a whole life insurance contract actually understands that it's going to endow or at age, usually in today's modern contracts, at age 121, you're going to have a guaranteed side that's going to endow, and then you're going to have a non-guaranteed side, which includes in dividends that are going to endow. Dividends are not guaranteed, but it does not affect whether the guaranteed side is going to stay in place or not.
So
So,
to be clear, whole life has a portion that's also not guaranteed. However, even if you were never paid a dividend on your whole life policy, since the dividends are not guaranteed, even if you were never paid a dividend, they would also never raise the amount of premium in order to facilitate the guaranteed death benefit that was illustrated to you when you signed the contract. Is that correct?
Correct. That is
Okay.
correct. And just to make a clarification, although dividends are not guaranteed, all the companies that we represent, 120 years plus, have always paid dividends. Maybe not at their declared at the very beginning of the contract, sometimes greater dividends, sometimes less, but they've always paid dividends. Where
That was my next point.
you cannot say that about the universal life policies. Sometimes they don't get credit. Sometimes the stock market goes down. Sometimes interest rates go down. So you cannot say that on that side. So there's, even though they're both not guaranteed, you can see where I believe the whole life is highly more probable to get crediting through the dividends than the universal life policies. Now, when you're trying to have estate planning purposes, some people on this are listening to podcasts says, "Well, I'm never going to go above the exemption limit, even if you think it's never going to go back down to $1 million, but you still might want to use one of these permanent policies to build up additional death benefit that you want to leave to your heirs. So you still need to consider the fact that what's the best product for that. So now, Rachel, I think we need to get into what a modified endowment contract is. And a modified endowment contract actually then will affect the tax-free status of accessing cash value while you're still living.
Let's go ahead and do that. And then just to be clear, if you're listening and you're not quite as familiar with life insurance, please hang on to your hat and jump in and ask questions if we're losing you at all in this description as well. Even if you're listening and it's not live anymore because we've already had it live, and maybe you're listening in 3 or 6 months or 2 years from now, you can pop questions into the comments section to ask us for clarification as we're going as well. So to be clear,
Yeah.
so far we've talked about various types of permanent life insurance policies where you have these variable, universal, or index universal products that don't have a guaranteed premium. And then you have over here a whole life product with a guaranteed premium. So that's kind of the distinction that we've made so far. And now we're going to add in a third category, if you will, of distinction. Go ahead and talk about what is
Yeah.
a MEC.
Yeah, but before, I'm sorry, we just got a great comment here. Warren Barnes wanted to make sure we wanted to spell out the equation of guaranteed universal life, guaranteed VULs, and guaranteed IULs. And there are products out there that work much more like term products, where the amount of premium is guaranteed for a certain amount of level death benefit, and that level death benefit is guaranteed at a certain level, much like the guarantee of whole life. However, when we're talking about estate planning and we're trying to increase the death benefit along the way, those products may not be suited for this conversation today. But we could certainly do those into the future. We're trying to show the pitfalls of the difference between the MEC policies and the trying to get the most death benefit for your premium. So thank you, Warren, for doing that. We're actually trying to show more of the pitfalls, though, of these other products where people are trying to get the maximum death benefit for the minimum amount of premium. So that is a really good segue into modified endowment contracts, because modified endowment contracts actually came about in the 80s, where there used to not be a restriction on how much premium you could put into a permanent life insurance policy when it came to trying to figure out whether it could grow tax deferred, access tax free, and then the death benefit be tax free. And this came to a head in the 80s because interest rates were very, very high. So the universal life products looked really good. Even the whole life products looked really good because they're interest rate driven also. And people started to say, well, I can actually store my money into the bank where I'm getting 10, 12, 15% interest on savings accounts and CDs, but those are taxable. Or I could put them into an insurance company, and the insurance company will say it's can grow pretty much the same rate, maybe a little bit less, but they are not going to tax me on the gains, and I can pull the death benefit down very, very small, and I can actually have a lot of cash value relative to a very small death benefit. And when this started happening, Congress started saying, whoa, 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 this is not why we wanted life insurance to grow tax deferred and the cash value to be accessed tax free. This is not why we want to do it. What you've actually turned this into an investment. We wanted people to be incented to buy life insurance to help take care of their family when they die so that the state didn't have to take care of it. And that all makes logical sense that they would put an incentive in the tax code. But when people started taking advantage of this incentive, Congress then came about and they put in these modified endowment contract laws. Now, to keep this simple and not get into the math, basically what the Congress said is all single premium life insurance contracts where you just make one large premium payment and no more, or they don't even calculate anymore, we are going to consider that a modified endowment contract. And a modified endowment contract actually means that any cash, even if you're borrowing it against, will be considered taxable. And it's even above what normal people say the cost basis, because it's what we call in the financial service industry LIFO, last in, first out. So any increase that you make for tax purposes is considered you're accessing that first. So the cost basis is not considered in this situation. So that Congress is really saying to people, we're going to do this modified endowment contract because we do not want this to be considered an investment. Can it be used as a tax-free savings tool? Yes, but you're going to have to follow our rules. What are our rules? Well, I already talked about the 1 year single premium test, and then what they call the 7-pay test. So they're saying that there are what called corridors. You can put in over this 7-year period so much money, and it has to have a death benefit that is commensurate with that type of premium that would be considerably above that. Now, the calculation depends upon your age and the face amount, and we won't get into that calculation today. We'd have to bring an actuary in to do that. And they're also stated, and then I'll take a breath and we can dig into this a little bit more. They're also stating that any unused premium from previous years can accumulate and you can then catch up during that 7-year period. So to wrap this up is you're only allowed to put a certain amount of cash dependent upon that death benefit, and that death benefit has to be considerable in consideration of how much premium you put in.
Okay, so in order, Bruce, and let's make sure that I'm saying this correctly to recap what you just said. So, Bruce?
Yeah.
Okay, I just want to make sure. I thought you were frozen. Oh, okay, so in order to not make a policy and keep the tax advantages we're talking about, your death benefit needs to be high enough and your premium low enough, essentially, correct?
Yes.
So then there is some reason for which somebody may consider making a policy. And what are those reasons? Why would a mech be advantageous?
Okay, because for estate planning purposes, people are trying to get as much death benefit, presumably for the smallest amount of premium. But if that smallest amount of premium is below the modified endowment contract premium, it will become a MEC, and then they will have to pay they'll have to pay income tax to access the cash value. Well, some people say, that's okay. I'm never going to access the cash value. I'd like to pay the lowest amount of premium for the highest amount of death benefit. And if it becomes a modified endowment contract, I don't care, because I'm not going to access that. And even if I do, this is what I think a lot of insurance agents miss. Even if I do, I'm paying income tax. But if I would have put that money into an investment somewhere and it grew, I would have had to pay income tax. So I'm not really that worried about it. So people that are planning not to access the cash value, or they want to have the maximum amount of death benefit to pass on to their heirs, and we'll talk about the different reasons to pass on to their heirs, and they don't care because all death benefits get passed along tax-free, then they may consider actually making a policy, because they're like, well, I'd like to get a lot of premium in early, build up that cash value. I don't care if it's past the modified endowment contract rules. I'd like to get a big death benefit really quickly. And so that is one reason they would consider. Now, why is life insurance so good for estate planning purposes? So I'm going to lower the exemption limit back down to George Bush's time. So that was $1 million. So let's say you have a $6 million estate. That means you are $5 million over the exemption limit. Now, they could change the percentage of tax. They could actually make it marginal, like it has been in the past, and I believe it's still marginal now, but it's squeezed a little bit. Let's not even talking about the marginal. Let's just say the taxes at the time you die is 40% above the exemption.
40% of your estate for any amount that is over the exemption limit. That's
yes.
What you mean. Okay.
That would be from 1 million to 5 million. So for that $4 million, you'd have to pay 40%. So 40% of 4 million is $1.6 million. Now, that $1.6 million can come out of that $4 million. It certainly can. But the problem that a lot of people have, high net worth people have, is they have a lot of times they have a lot of illiquid assets. So now they have to sell the asset when it's down, or they have to sell the asset to somebody that knows they have to sell. So they're never going to maximize the sale. And frankly, $1.6 million is a lot of money. So now
especially if you and your heirs are intending and planning on the 4 million is the amount of transfer at your death, and now you're cutting into that by 1.6, that's reducing it significantly, all the way down to 2.4 million. So that's a huge cut into what the expectation was.
Correct. 2.4 plus the 1 million exemption, so it'd actually be 3.4.
Yes.
Just to be very clear to the audience.
That's true.
So so what people like to do then in this situation is they would like to pay some premium, which will be considerably less than 1.6 million, to get a death benefit. Now, we don't know your age, we don't know your health, we don't know your habits, so we're not sure that the premium will produce 1.6 million that you would like, but it's going to produce something to offset the 1.6 million. Now, when you die, the 1.6 million of death benefit can be used to pay the 1.6 million of estate taxes, so you retain the entire $4 million. Now, just to be very clear, you have to take premium out of the estate to actually pay for the $1.6 million of death benefit, but that will be considerably less than the $1.6 million.
Yes.
Now,
So what you're saying is there is a cost to doing life insurance. It's not that you can wave a wand and get the death benefit of the life insurance to cover the taxes without having the cost, which is going to eat into your initial estate of 5 million. You're going to have to use part of that up in order to get the advantage to have the life insurance pay the 1.6 million tax.
very good. And that I know people that are listening would say, yes, but now it's actually even more than 1.6 million, because that $1.6 million of death benefit, even though it's income tax free, now gets placed on top of the $5 million estate, and you're at 6.6 million, and you have to pay estate taxes on the 1.6 million also.
Okay,
So
can
now,
you re-say that? So
okay,
can you just
so
state that again?
so let me try it from a different angle. You pass along from the normal assets $5 million.
Yes.
But for estate planning purposes, that person also put a $1.6 million life insurance policy on them. So now that also goes to into the estate. So that's 5 million plus the 1.6. Now you're at 6.6. Now you have to pay estate taxes from 1 million to 6.6. So now instead of paying estate taxes on 4 million, you're paying it on a 5.6 million, because you do get a $1 million exemption. So now 40% of that is going to be even greater. So then people say, well, see, the death benefit didn't pay for all my estate tax. Well, we don't know if you could have a bigger estate, but yes, death benefit is not, it is income tax free, but it's not estate tax free. Now,
Yes,
I
and
want to,
that's the key. That's the key. Because you heard us say before, you would get all these tax benefits on the life insurance, the tax deferral of your cash value growth, the tax-free access through policy loans, the income tax-free death benefit to your heirs. It doesn't hit their income tax. Your heirs are not taxed on the proceeds. They do not pay income tax on the death benefit proceeds that they receive. However, it does it does pertain to it increases your estate. So that's a very clear distinction that needs to be made.
now we're not going to talk about this during this podcast, but you could put that life insurance policy into a irrevocable trust that the beneficiaries are your heirs, and that irrevocable trust, irrevocable life insurance trust, are what people refer to as an ILET. So then the death benefit goes in there, but it can be accessed. The trust can be accessed by your beneficiaries, because the beneficiaries are the beneficiaries of that ILET. And then it doesn't go to your estate. That is a very highly used estate planning, so that you don't have to pay additional estate taxes on that. The disadvantages of that are you lose control of that. But for this particular podcast purpose, we're actually trying to explain why people would do a modified endowment contract for estate planning, and what are the considerations of using whole life or the different types of index universal life that are not guaranteed. We're not talking about the guaranteed ones right now, because the guaranteed ones are more like whole life in that situation. Okay, so now why would you use universal life, variable universal life, or index universal life over whole life? Well, because they are not guaranteed. When the actuaries actually price these at the insurance company, they can price in more lapse situations where people surrender the policies because they're not guaranteed. When they do that, before I go there, and they're also pricing them according to part of the premium is being paid for by the interest rates, the sub accounts, or the indexes. So the price of the premium to the consumer is considerably less because it's not guaranteed. And we all know that if something's guaranteed, you actually are going to have a higher cost no matter what it is. So just keep that in mind when you're trying to wrap your head around this.
And when you
So
said the whole lapse situation, I mean, that's something worth noting as well. You're saying that if you have a non-guaranteed premium, meaning your premium that's required of you could be higher than illustrated. And there are people who end up in that situation where they get into their 80s and 90s, and the premium required to keep the death benefit in force of these universal category of policies, IULs, VULs, and universal life, if the premium is higher and they do not maintain that policy, the policy lapses. And so that is all, the lapsed policies then are to the insurance company income because they have received all this premium and there's no cost. The mortality cost then goes down because they don't have to pay out as many death benefit claims as they had intended to pay. And so because those that's how the lapse situation is impacting the insurance company's ability to charge you less as well for those policies. Is that correct, Bruce?
correct. So they know that the lapse ratio of those will be greater than the whole life ones. So they can price them cheaper. And as I said before, they also know that part of the premium is projected to be paid by the the index, the interest rates, or the sub accounts. Thus, they're not figuring that into the cost of the insurance for the well, they are, but it's not actuarially figured in because if they don't perform, then the death benefit doesn't go up, so they don't have an increased liability situations. So all that is figured into the pricing. Thus, it means per $1,000 that those universal life policies can be paid for much more cheaply than the whole life that has a guaranteed premium that's not going to go up. So people can project into the future how much their cost is going to be. I'm not saying whole life doesn't lapse, but the lapse rate is considerably less because people know what the premium amount's going to be. So they can figure that into the pricing. Well, when they know it's not going to lapse and they're going to be on the hook for more mortality costs in the future, they have to price it higher. So the cost per thousand then for the whole life is higher. So if you want it to be guaranteed, you would probably consider, now we're not going to get into the guaranteed universal life, guaranteed index universal life, because they actually cost per thousand is much more closely related to whole life, but you would consider whole life. If you want to take a risk and try to get the most death benefit for the least amount of premium that's coming out of your pocket, and you're relying on the index, the sub accounts, or the interest rate environment, then you would do the index universal life, knowing that they're not guaranteed, and you may need to come to the table with more premium into the future. So just consider that to be the fact. The problem comes in is that if you do not plan, especially in an illiquid environment, and a lot of high net worth people are in a illiquid environment, and most of it is wrapped up into real estate or into their business, then the heirs must sell that business or that real estate at a time where people know they must sell, and they will not get the most value for that asset. And so that's why having a well-designed life insurance estate planning process, whether you use an IUL or not, can be very, very beneficial for estate planning purposes.
So we did talk about islets about 2 weeks ago. In that episode, we can link to this one in the show notes. You can access that information. You can go back and listen to just talking about the value and benefit of why and why not you may consider using an islet, the control you give up, but the benefits you gain. And so that is, again, a separate conversation. But today, Bruce, I think the main thing that we can extrapolate from this is that if you're in a situation where you recognize that there could be a higher premium due for a universal product, a universal life product, and that premium that could increase in the future, you have the capability to handle because you have liquid cash and you're willing to assume that risk, then you could use a universal product for estate planning purposes to pay the death benefit or to pay estate taxes if you're trying to get the maximum premium for the least amount of premium dollars. But you have to understand those risks. If you're in a situation where you say, I want to make sure that I'm in a guaranteed situation and I know what the premium dollars will be, and I know that these premium dollars will create this amount of death benefit, and you want those guarantees inside of your planning because you don't want to liquidate illiquid assets or you don't want to have additional premium be potentially due. And we're not saying that it will be, but in many cases it has been requiring additional premium in those types of policies. If you want to have the peace of mind to know that you will not have additional premium be called for in order to support the death benefit that you are expecting, then whole life would be a better product to use in that case. But Bruce, that brings us back to the mech situation. So why and why not would you use a mech? And to be clear as well, for my purpose and for anyone who's listening, is mech simply something that can happen on a whole life policy, or can you mech the other policies as well, the
No, you
universal
can
policies?
you can make any permanent policy.
Okay.
So what I'm about to say now, you can take and just apply it to any permanent policy, whether it's whole life, universal life, um, index universal life, or variable universal life. The reason people may want to mech a policy is they will get the most amount of death benefit for a either a single premium or a short pay, or maybe even a lot more death benefit for a longer paying premium policy. Maybe you want to pay for 7 years, eight, maybe you want to pay for the whole contract, but you want to actually get the most death benefit for that premium. Then people will say, I'm going to go ahead and make some really big payments, cash payments for premium, and get an initial really big death benefit over that 7 years that does not pass the 7-pay mech test. So we already know a single premium will not pass. 7-pay will not pass if it's too much death benefit per premium. So you can see right away that, all right, what you're trying to do is get more death benefit for the least amount of premium. So, but a person says, I don't care if it mechs. I don't care if it's growing tax deferred but I can't access it without paying taxes on it. I don't care because one, I never going to access it, or two, even if I access it, I don't care what I'm paying taxes for it. I want this big a death benefit as I possibly can per premium dollars. So that's why a person may do that, because they don't feel like they're going to access it, or they definitely want the biggest premium for estate premium for death benefit for estate planning processes. So that's simply why they would do it. Now, I always caution people, because I say, now, you might not think you're going to want to access it now, but you may have reasons to access in the future. Are you going to be okay with the tax situation? And a lot of people, if they're very sophisticated, and usually if they have a high net worth, they're pretty sophisticated, they say yes, because if I had this over here in an investment and I needed to access it, I'd have to sell the investment and pay taxes on it. Now there is a strategy where you could do both. You could set up multiple policies, and you could have one that is not mech that has cash value that you can also use for estate planning purposes, the death benefit, and you can have another one that you mech and you actually put into an eyelet, or even if you don't put in an eyelet, you're still getting to get the benefit of a lot more death benefit per premium. So there's a variety of strategies you could use. That's why if you really sit down with not only your tax preparer, your state lawyer, with your financial advisor, your insurance agent, and work on something together, you can come to that balance in your life that you're comfortable with. So that's what you really need to do, is get everybody to the table to decide what you're comfortable with.
I like that you're mentioning the strategy of utilizing the whole team approach because it's not as simple as just one answer and it's not one size fits all and it's not one type of policy for every situation and it's not one type of policy for everyone in various estate amounts. And there needs to be a custom designed, custom tailored approach to fit exactly what your needs are with your type of assets and the liquidity that you have and your level of risk tolerance and your understanding of paying tax and where that would come from. So, as Bruce is laying out here, this is why it's a complex topic. It's why you probably haven't found a one quick answer as you might be searching for information on this situation. And it's also why there's the necessity to have that whole team approach. So, Bruce, you had mentioned earlier in the podcast that there's different reasons to pass on wealth to your heirs. And I think we need to circle back to that. I think there can be, again, many different purposes that somebody is trying to solve for. And one of those could be I have businesses and I have investments and I have real estate, and I want to make sure that I preserve that capital and those assets for my heirs because I want them to pick up where I left off and I want them to continue running the real estate and run the businesses, and I want them to have the not only the responsibility to run it, but I also want them to reap the rewards. I want them to be able to get the advantages of this ownership that I've been building, and you might even be building with your kids, or you might be in a transition process to the second or even third generation. So that is maybe one reason. You have this other consideration of thinking about how to pay the income or pay the estate tax so that you preserve as much of the capital for the next generation as possible. And I see another component of building up family banking. And this is something that's, I think, becoming more and more on the forefront of somebody's mind as they're thinking about how do I have capital available for my family to be able to access and use during lifetime. This could be for starting businesses, it could be for creating investments, it could be for investing in things that are going to benefit and grow the family and having that accessible capital. Bruce, I'm sure that there's additional things that are on your mind as well, but
Yeah,
can you just
charitable giving would be college, to pay for college. There's educate or other educational processes. There's all kinds of things that people would like to build up as much money as possible. Um, what I find interesting is it's a mindset thing, and I don't, I think when I talk to people, clients, you oftentimes get two different mindsets. You get one mindset that says, "Yes, I want to leave as much money to the next generation as possible. We have to do estate planning. We have to build this for generations and generations. And they're going to be great stewards of this money, and they're going to continue to build it. And it's going to be great for future generations. They're going to remember, our family and what we did, and we're going to be able to make charitable contributions forever and ever and ever." And then you have other people that are saying, "I don't want to do that. I worked for all this money, and I don't know why they can't work for and build their own stuff up." And it usually comes from this idea that when I leave money to the next generation, I'm somehow going to ruin them and spoil them, and their life is going to be just tragic because of all this money I left for them. Number one, there is ways for the actual trust to actually be designed to say, okay, you can access this money or have money in this from this trust if you do this, and this, and that could be including being a good citizen. Could be including being a productive person in society. It could be that you have to do so much charitable work with this. There's all kinds of things. But the other thing, Rachel, and I know you work really hard with families with this, is if you actually are being good stewards with the family and educating them and teaching them along the way, that should never be a concern of yours. They would actually be on the same game plan as you are. So I don't know if you want to
Yeah,
elaborate
Bruce.
on that.
Yeah, absolutely. I think what's really interesting is we do see these two divergent mindsets. This, I want to build together with my family and strengthen the next generations as much as possible. But the question behind that then is, but how do I do that? Because I've seen the impoverished nature, the impoverished mindset that can be created by passing along wealth with the lack of preparation, or by ill-prepared or unequipped heirs who then think of themselves as a recipient of all of this stuff that they can spend and they can use and they can do whatever they want with, and they're thinking of themselves as a consumer rather than as a producer, as someone who is co-laboring with you as you've built this business or built this wealth in your family. And so there is a way to ensure that you're not only training your next generation in stewardship, you're bringing them along on the journey, you are creating not only the ability for them to have assets, but also the guidance to use them well. And that's really important because there's not just two polar opposites. There's not just give them everything and let them do whatever they want with it, or give them nothing because you can't trust them. There's somewhere that you can balance that concern that I don't want to give it improperly. I don't want to throw a meteor or throw a landmine, throw this just lavish wealth on them without the preparation. But I also don't want to prevent, I don't want to prevent them from reaping the rewards of what I've built. I want to allow them to stand on my shoulders. There's a way to be able to do that together with them, with the proper training. And really, what we've found is that in all wealthy families, this is something that across generations and across cultures, you see this shirt sleeves to shirt sleeves proverb, where you have the family that builds wealth as generation one. By generation two, they get accustomed to the lifestyle, but they see the work ethic that created the wealth to begin with. But by the time that they have children, the grandchildren of the first generation end up in a position where they're used to the lifestyle, they're continuing the lifestyle, but they don't remember the work ethic. They don't see what created the wealth to begin with. And they spend all the money and end that family back in poverty to start over again. The families that rise above this, the families that break off that curse of the wealthy, are the ones that invest in the family well. And that's everything that we do with Seven Generations Legacy and the work over with legacy planning and legacy coaching, because there absolutely is a way to equip families to not just have the wealth and the estate plan, but to have the guidance and the meaning behind all of the planning that you did so that you're communicating well and you're allowing that wealth to flourish and allowing your family to flourish on the basis of the wealth that you've created. So Bruce, I love that you brought that into the context of this conversation because, yes, the families who want to do this really well not only want to pass on the most possible, but they want to do it right. So today we're just talking about the money component. We're talking about how to pass on as much wealth as possible by limiting the estate tax and by being in a position that you're having the greatest death benefit that can pay into that second generation or your heirs. So don't leave the conversation there. It's not just about how to have the right life insurance strategy. Really, it's about how do you have the estate plan that is not just a free-for-all, and how do you have the right guidance supporting your estate plan so that everyone has the right understanding and they can use the wealth that you've created and given them through life insurance.
Yeah. Let me this isn't directly related to what we're talking about today, but Chosen One left a message. He says, "What happens when your policy agent is old and or has big health issues?"
Mhm.
And I think what he's saying is, everybody's going to die, even your agent. Who will serve my policies if the agent passes away? Who will serve my policies going forward? Thank you, from Texas. Well, this is one of the reasons why you should in my opinion, you should work with a team that has a succession plan. If you're working with an individual agent, you should actually ask them, what happens if you're no longer in the picture? And if their response is, oh, well, I have so and so in my office, or I have another person in my office, and they would take over my book of business, that's pretty good. But I would also ask them, well, what happens when that person passes away? And you can't actually ask them necessarily what their age is, but you can ask them what happens when that passes away. We have specifically through the Money Advantage and E3 Wealth, we've actually looked at succession plans. One of the greatest indicators of a succession plan is how many people you have already talked to on the team or have been on meetings. So if you have multiple people on meetings, you should feel very good that that person understands you, understands your situation, and can take over for you. And although once again you can't ask their age, you can definitely see that they might be younger, and that is good succession planning. But chosen one question, if you don't have that, or even if you say I do have that, but what happens if the whole firm business collapses? What happens? Well, you become what's known as in the industry as an orphan. So they're called orphan policies. So now you don't have anybody to take care of you. That's what you're asking, chosen one. Good life insurance companies actually will now reassign your policy to the next agent that they have. And they will target, good life insurance companies will target certain agencies or agents that they believe in are very good, and they will give them orphan policies. Now, I've been doing this since the 80s, and I'm going to tell you that even though they hand those off to other agents, it's been my experience that you will not necessarily get serviced the same way as that agent who had sold somebody else a policy and has a personal relationship with them. So that is why I would tend to try to work with people that have an agency that has a succession plan, because it's just human nature. You're getting these additional policies. You're not going to get paid on them. You're supposed to service them. The idea is if you service them, the death benefit will go to the next generation, or you could have additional um, sales from additional life insurance from that person, or the death benefit to the next generation. You will then service them. But it doesn't work out, in my experience over the last 40 years, it doesn't work out as well as people think it's going to work out. So I would suggest you try to work with an agency that has a succession plan. But thank you for that question. So Rachel, I think
Excellent
I
question.
I don't have any more questions unless you have it.
No, I think that's really the scope that we were wanting to cover today. And of course, we could talk about probably even more on this, but I think we've covered the big picture. We've covered why would you use life insurance to do estate planning. We have talked about why you might consider the pros and cons of whole life or the pros and cons of an IUL or a universal policy. And maybe I should just recap that really quickly. So, why would you use life insurance for estate planning? Not only do you pass on a death benefit that's leveraged up from what you've put in terms of premium, so you have the most death benefit that's getting to your heirs, you also have the capability of using a policy that has cash value buildup that you can access and use. You have tax advantages if you use certain types of life insurance and you don't mech the policy. And you also are in a position where you have the ability to use that death benefit that's paid into your estate that increases the amount of your estate, but is not income taxable to your heirs to be able to pay some of those estate taxes. And so those are some of the reasons to use life insurance for estate planning. And then just to recap why you would look at the universal products, those usually are going to have a lower premium for the amount of death benefit. The challenge with that is that there are risks associated because it's not a guaranteed premium. You want to be in a situation that if you are utilizing those universal products, that you recognize that there could be the requirement of additional premium in the future to keep your policy in force. And so whole life is something that provides a guaranteed premium that will not increase. And you have the ability then to know that you're not going to have additional premium dollars be required in order to keep your premium or your death benefit in force. So that's really the full spectrum that we've covered today. We've talked about MEC policies, and the pro of that is building higher cash or higher death benefit. The con of using a MEC, the negative side of using a MEC for estate planning purposes, is that you might decide later on that you really did want to have access in a tax advantage way to that cash value. But again, we've talked about there's strategies where you don't have to just use one policy and one type of planning. You can have a whole strategy, and you need a team approach. So I hope that we've given you some food for thought today as you're considering not only your current estate taxability, but also the potential of your future estate taxability and the liquidity of your assets and your goals for passing on a death benefit to your heirs. So with that, we're going to go ahead and close here. If you would like to explore this conversation with our team, you can go to themoneyadvantage.com. You can book a call with our advisors and discuss what your goals and needs are in terms of life insurance planning. We do a lot of work around infinite banking and family banking, so that might be your direct ask or your direct question there. If you're really looking for more questions and concepts and thinking and strategizing and problem solving around estate planning and life insurance regarding estate planning, you can also book a call with me to really talk about the legacy planning process and how we can best serve you with a strategy that will accomplish the purposes that you have in place for your legacy and your estate. So with that in closing, let me direct you to that link. That is over at sevengenerationslegacy.com/strategy call. We'll make sure you have both links in the show notes as well. Thank you so much for your time today. If you do have questions after the fact, please share those with us in the comments. You can also email us at hello@themoneyadvantage.com, and we'd be happy to not only respond to your question, but potentially even direct a future podcast around your thoughts and questions. So without further ado, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.